All right. Well, my name is Frederick Middlebrooks. I want to thank everyone for taking the time to log in and bless us with a little bit of your time this evening to show you a little bit of information about down payment assistance and a couple other things about the housing market that I believe will be very beneficial to you as well as other people that you might know who are considering purchasing a home or in the market to potentially purchase a home. So, uh, this is Cynthia Davis, who is also online with us this evening. Thank you, Cynthia, for joining us. Cynthia has been in the real estate market for close to 30 years now. She is a real estate broker and business owner, and she is also an approved real estate instructor for the National Association of Realtors as well as the Georgia Association of Realtors. So she trains other real estate agents on how to be real estate agents. So she's been doing it a while. And thank you, Cynthia, for blessing us with your time tonight. We greatly appreciate it.
Thank you for asking me to be here. I appreciate it.
All right. And if you have any questions or anything throughout the presentation, please feel free to type those in the chat. If you have something of a little more personal matter, you can feel free to reach out to me afterwards. I'll be providing my contact information at the end of the presentation as well. So you can reach out to me directly if you have anything that you'd like to ask me offline. So with that, we will go ahead and get started with the presentation. All right, can I get a thumbs up if everybody, are you seeing this good? All righty. So let's buy a home in 2023. Thank you. Thank you. I'm seeing the thumbs up. So thank you. Let's buy a home in 2023. So I think that now is a great time to be purchasing a home. There is a lot of opportunity on the market right now. And a lot of people are shying away because of one thing, which is interest rates. And that is the one thing that you should not shy away from when it comes to purchasing a home, because it's the one thing that you can change throughout the course of a mortgage. Your interest rates go up, they go down, but when they go down, you can always refinance into a lower rate. So we'll get a little bit more into that as we go throughout the presentation. But as I mentioned earlier, I'm Frederick Middlebrooks. I am a loan officer with Van Dyke Mortgage. And you see my NMLS number, which is a number where you can actually look me up in the NMLS system and just see who I am and where I work at and things like that. So I'm also a Navy veteran. I did 7 years in the U.S. Navy. Very proud of my time. It was a great time. And if I could do it all over again, I would do it the same way because I had a lot of experiences and things that I learned in the Navy that I just wouldn't trade, and they really developed a lot of things in me. So with that, let's get on with the presentation. So your journey to home ownership. Home ownership is starting out with the application, and this is all going to be from the perspective of a loan officer, which is what I am. So I help people get the financing to purchase a home. So we start off with the application phase, and in the application phase, we'll be getting your social security number, your personal information, such as where you live, where you worked, how long you've worked there, how much money you're going to be putting down on a home, if you're self-employed, and things like that. And so with that, we move into the pre-approval phase where we will pre-approve you for a home, and that's based off of how much money you make, how many debts you have, meaning your car payment, how much that is, and if you have student loans, credit cards, anything of that nature. We calculate all of your debts, all of your income. We see how that balances out. And we also look at your employment history, how long you've been working, and we look at your credit score. And we'll get into credit score in just a minute. But we take all of that and we pre-approve you for a certain amount that you qualify for to be loaned to purchase a home. So after you receive a pre-approval letter, then you would go talk to someone like Cynthia, and Cynthia and you would go house hunting. So you would go and find the house that you want. And after you find that house that you want, you come back and we would submit your loan to processing and to underwriting so that it could get approved, moving towards final approval so that you could actually get the money for the loan. So the first step is a conditional approval. That comes back from underwriting. We satisfy those conditions. Then we move on to the final approval. And after the final approval, we are cleared to close. We move to the closing and you've got your house. So credit scores, where do you stand? this screen is just to help give you a indicator of what good credit scores are, what are medium scores. And then at the bottom, you'll see if your credit score is less than 580, let's talk. Now, that's not to say that if your score is below 580, it's an automatic disqualifier, because it's not. FHA will actually approve loans as low as a 500 credit score. But if your credit score is anywhere from 500 to 579, then you need to have a 10% down payment. Whereas if you're 580 and above, the minimum down payment you would need to have for an FHA loan is 3.5%. So just to show you what the difference is, for a $300,000 home, a 3.5% down payment is $10,500. But for the same $300,000 home, a 10% down payment is $30,000. So you're talking about a $19,500 difference between the down payments if your credit score drops below 580. So you really want to make sure that credit score gets up above 580, and really you want it to get higher into the upper 600s and 700s if possible, because your interest rates will be better if you have a higher credit score. This is a fun slide that I just put up just to let you know kind of what the average credit scores are for this is the average throughout the US that you see on the left side of your screen. And then based on your generation that you fall in, you can see what the average credit score is for your generation. And you'll notice that the older you get in your generation, the better your credit score gets. You got a little bit more time to smooth out that credit score, and you probably have hopefully accumulated some assets like a home, which also paying on-time mortgage payments helps a lot with building good credit. With me being in Georgia, I also wanted to put the Georgia average credit score up there as well, which is 693. So we fall a little bit behind the national average here in Georgia, but you'll see that year over year, the nation's average has been going up and up and up. And with us being in 2022 right now, we don't have the 2022 numbers, but I believe they're somewhere around 720 or 721. But last year, the average came out to about 714. So just so you know where you kind of fall at with where your credit score is right now versus where the national averages are, as well as your generational averages. Moving on into the meat of things, if you purchase this home today, this is an actual listing that I pulled up online. This is a house for sale for $355. We'll round it up and say $355,000. Now, I put the other parameters in. So if you purchase this home at $355,000 for 30 years, at a 7.5% interest rate, your monthly principal and interest payments would be $2,395. Now, that's not including your taxes and insurance, but just your monthly principal and interest payments would be $2,395. So you might say 7.5 is a high interest rate to pay. I think I'll wait. This is what that's going to cost you. Let's say you wait 6 months and interest rates go down a percentage point. Now you save $210 on your mortgage. So good on you for waiting, right? Because that $210 that you would have saved on your monthly payments just by waiting 6 months. If you wait a year, let's say interest rates go down to 5.5%. Now you're saving $381 on your monthly payment. So just by going from a 7.5% interest rate to you waiting a year, now you're paying $381 less per month on your mortgage payment, and that is a large chunk of money. You wait 2 years, $404, 3 years, $314. Now you might be thinking interest rates between years 2 and 3 are both at 5%, but you're not saving as much in year 3 as you are in year 2. The reason is because of what I'm about to get into now, which is appreciation. So homes get more valuable over time. And this is based on average appreciation rates of a home in a particular area. So in the area where this home is located in, which happens to be in Henry County, Georgia, based on the average appreciation, in 6 months, this home would have appreciated $2,900. You also, over that 6-month period, had you purchased it right away, would have paid $1,500 toward the principal balance of that loan, which means that total, you would have $4,500 worth of equity in your home. $4,500, a whole lot more than this $210 here that you would have saved by waiting, whereas you would have had $4,500 in equity if you would have purchased right away. You can see the trend where we're going. After a year, that home is now worth $11,000 more. You would have paid $3,100 toward the principal balance, totaling $14,000 in appreciation, or excuse me, $14,000 in equity that you would have had in your home. So same thing with 2 years, $25,000 more, $6,500 paid, $32,000 in equity, and $41,000 more. Now, this is why waiting to the third year with the same interest rate actually doesn't save you as much money, because in year 2, you're paying $25,000 more for that home. But in year 3, you're paying $41,000 more for that home than what you would have paid if you had bought that home at the beginning without waiting at all. So $41,000 more, $10,000 that you would have paid over that 3 years in equity in the house instead of paying rent where you get none of that money back. A mortgage, you put some of that money into equity in the home. $51,000 that you would have had in equity in your home if you had purchased it right away. Now you might be like, well, what if interest rates drop more than 6%? Well, let's just 5x this number and say you would have saved $1,000 a month after waiting 6 months, which is highly unlikely, but let's just say you would have saved $1,000 a month on your monthly mortgage payments, because interest rates go crazy and back down to 3 or 2% or 1%. That still puts you at less than what you would have had if you had purchased it right away, because you would have had $4,500 in equity, not to mention that you can refinance your home when interest rates drop. So now you get the $4,500 in equity when you purchase right away, plus you can refinance your home to whatever the lower rates are, and you get that lower rate. So moving on to cash to close. Cash to close is an important thing to know, because I'm dividing this into 2 different columns. You've got your down payment, which is what we are going to talk about covering. And then you have your closing costs. Your closing costs encompass your prepaids, which are your taxes, your insurance. And I'm also putting in there any discount points that you're going to pay to buy down your mortgage, or excuse me, buy down your interest rate, as well as attorney's fees for doc preparation fees, filing fees, recording fees. Any of those fees, I'm roping all of that into closing costs, which typically you'll see about 2 to 5% is the cost of closing. And your down payment on an FHA loan is 3.5%. All of our down payment programs that I am speaking with you about tonight are all FHA programs. So the minimum down payment requirement is 3.5%. So down payment assistance, we cover that 3.5% for you. How much is that on a $350,000 home? That's $12,250 that you don't have to come out of your pocket when you come to purchase a home. You would just have to worry about paying the closing costs. So let's say if closing costs were 3.5%, that means you're coming to the table with about half as much money as you would if you did not have down payment assistance. So with the programs that we're offering, it's again covering all of your 3.5% down payment for because these are all falling under FHA. So it's covering all of that 3.5% down payment. And you're just focused on those closing costs again. And there are different parameters depending upon the program that you qualify for. And the reason I say qualify instead of select is because there are different requirements depending upon what your credit score is, as far as which program you would actually qualify for. But with that, what do you need to qualify? So start off with a job would be nice, preferably a 2-year work history, but you can have less than a 2-year work history, and I don't want to get too far into the weeds there, because I do want to save time at the end for questions, but you can have less than a 2-year work history. But for instance, let's say that you were in school for nursing for a year and you got out and you've only been working a year. We can count some of that schooling time to account for that whole 2-year work history. And there are some other things that we can do to help out with the work history part too. But if you have at least a 2-year work history, that is preferable. You need cash to pay closing costs, as we talked about earlier, which is a buyer responsibility. You need at least a 600 credit score. 620 is better because a 620 will open up another down payment assistance program to you where your down payment assistance is forgivable. With a 600, there is a program that you can still qualify for down payment assistance. It's not forgivable, but there are no and I'll get into it a little bit later, but there's no monthly payments and no interest on that down payment assistance. It goes onto the home as a second mortgage, and it just sits there. You only pay it back when you sell the house, refinance, or if you move out and it's no longer your primary residence. So preferably you want a debt to income ratio of below 50%. Now, talking about debt to income ratio, because I know that can be a foreign term for most people, I'll explain it very briefly. Let's say you make $10,000 in income, but you pay $3,000 in debt. Debts, I'm talking credit cards, student loans, car payment. If you have alimony or child support, we do calculate that as well. If you have other installment loans, we do calculate those other installment loans as well. So you have $3,000 in debt. It will be said you have a 30% debt to income ratio. Let's take the same parameters, but now add to it a $2,000 mortgage payment. And this is the mortgage payment for the home that you're looking to purchase. Now you have a 50% debt to income ratio. When you add your debts to your mortgage payment, divide that by your income, you have a 50% debt to income ratio. And this is how we calculate your debt to income ratio. So you want that number to be as far below 50% as possible. Now, I will say it is possible if your debt to income is higher than 50% for you to still qualify, but it is much easier to qualify if you have a debt to income ratio that is below 50%. Oh, and with one of the down payment assistance programs, also your debt to income ratio does also affect the rate that you would get on your credit as well. Usually it's not a factor in your interest rate, but for one of the down payment assistance programs that we have, debt to income ratio does play a factor in helping you get a better rate as well. So everyone wants to know, what's the catch of getting all of this free money? If I'm just giving money away, what's the catch? Higher interest rates. You will pay a slightly higher interest rate to get down payment assistance. There's no such thing as a free lunch, is I guess what the saying goes. And here that is, I guess you could say, the way that the lenders and try to recoup some of that money that they're giving you to pay for your down payment. Because essentially, like I said, that money is either going to be forgivable depending upon the program you choose, or you're just not going to have to pay it back until you sell the home, refinance, or move out and it's no longer your primary residence. So for them to just give you money to just sit or have it go away, they charge a slightly higher interest rate so that they can recoup some of that money back. But it still does allow you to be able to get into the home and purchase the home that you want without having to wait. And as we saw in the previous slide, waiting could cost you tens of thousands of dollars in equity in a home, because that home that you're wanting now, that's maybe 300,000. If you're waiting on it, it could be 320, 330, 340 by the time you come around to actually wanting to purchase that home. So what's the reward? 0 down payment, no interest on your down payment assistance, no monthly payments on your down payment assistance, and depending upon the program, your down payment assistance is forgivable. However, better pricing if repaid. So again, I'm not going to get into the specifics of all of the different programs. That's something that I would much rather talk with you individually about if you contact me, because there is a lot to go into with the specifics of each program, and I don't want to bore you with all of those details, but I will briefly say that, again, with one of the down payment assistance programs, it is forgivable. However, you can get a lower interest rate if you choose to repay that back over, I think it's a 10-year period of time that needs to be repaid. And I can discuss all the details of the parameters of how that gets repaid and everything on a one-on-one basis if you just contact me later on. So that's all I have. I will leave this slide up if you want to take down my contact information as well as Cynthia's contact information. I am always available, very easy to access if you have questions on loans or anything like that. And I'll check the chat just to make sure that there's no questions in here right now. So I do see one. Is there a cap on the FHA loan? So yes, there is a cap on the FHA loan. And let me see if I can check out, because the actual maximum actually is being increased for 2023. So what it was for this year is being increased for next year. And so right now, I'm seeing FHA loan limits at $472,030 for the FHA limits. But again, those are limits that I believe are increasing for 2023. So as it stands right now, it's $472,030 is the loan limit for FHA. And the down payment assistance does have a cap as well. The cap for down payment assistance is the 3.5%. So you can put down more than 3.5% if you want, but the most that we will cover in paying down payment assistance for you is the 3.5%, because that's the minimum required for FHA. No interest rates. So on the last slide, it says higher interest rate, but also states below no interest on DPA. So let me go back so I can. Okay, so I believe you're referring to this slide. So higher interest rates, what I'm referring to there is that the interest rate that you will pay is going to be higher than what you would pay if you did not use down payment assistance at all. So let's say that if you paid your own, let's say down payment of $12,000, and let's say hypothetically your interest rate would be 6.5%, but if you use down payment assistance, your interest rate might be 7%. And I'm just throwing out these numbers for the purposes of this example. So when I say the catch is you paying a higher interest rate, I mean that your interest rate is going to be higher than what it would be if you were to pay your own down payment. If you paid your own down payment, you could have a lower interest rate than if you use down payment assistance and we paid your interest rate for you. So with the, and that's the interest rate. So to cover the part where you said about the zero down payment, the zero down payment is just talking about the payment as a whole, which is the down payment portion of the house, the 3.5% that actually needs to be paid. But the higher interest rate is that it's higher than what you would pay if you did not use down payment assistance. So the no interest on down payment assistance, I think that's what you were referring to. The no interest on down payment assistance is your down payment assistance goes onto your home as a second mortgage. So let's say that you, on your the first loan on your home, you borrow $250,000. That's your first mortgage. And let's say you use down payment assistance, and that down payment assistance is another $12,000. That $12,000 goes onto the home as a second mortgage. So it's separate from the $250,000 that you borrowed initially. So no interest on the down payment assistance means that that $12,000 that you borrow for your down payment, there's no interest rate on that. You will pay a higher interest rate for the $250,000 that you originally purchased, or that you originally borrowed for the home. But the down payment portion of that, there is no interest rate for the down payment that you borrow. All right, let's see what other questions we have. What's the average turnaround times for these programs? So these programs actually, with the exception of the Georgia Dream program, Georgia Dream has a down payment assistance program, and those times we usually like to average about 40 days to close, because though the Georgia Dream has a longer, those loans have to go through Georgia Dream program in order to be approved and everything. So we usually like to average about 40 days for those. But as far as the other couple of programs that we have where you can get down payment assistance, the times are generally about the same as pushing every other loan. We generally average about 30 days to push those loans. And is the higher interest rate refinanceable later on to match market rate? Absolutely. Absolutely. So You can refinance those rates at any time. You just need to make at least 6 payments on that mortgage, and then after that, you can refinance that rate at any time that you like and get a lower interest rate. So you can start if you start off with a, let's say, 7.25% interest rate, you make 6 payments on that, and then you refinance it down to 5 or 4, or whatever the interest rates are at the time of your refinance. If you have one of the programs that, again, like I stated, you have to repay it back. You just have to keep that in mind, that your down payment assistance will need to be repaid when you refinance. However, you can include that in your refinance as well. So you can refinance the first and the second mortgage being your down payment assistance. You can refinance both of those and include both of those into your refinance to cover that money that you need to pay back. Do you have a list of foreclosed or distressed properties, bank, REO available to buy a house with these programs? So I'll let Cynthia speak a little bit to as far as where to find the foreclosed and distressed properties. These programs are not property specific. So as long as you as the buyer qualify, you can utilize the down payment assistance. As long as you're eligible and you qualify, you can utilize it, but there is not as a property specific thing.
Currently, Frederick, I'll speak to that question. And currently, we do not have a list of foreclosed properties, REOs. One being there's not an abundance of them on the market anymore. Secondly, they don't stay on the market long enough for a list to be produced. Normally, the market absorbs them because we have such a shortage of properties on the market right now. So we do not have a list. We just stay abreast of what is coming on the market on a daily basis and try and stay up to date that way. But a list could very well be old by the time you get around to looking at it because it changes. But as Frederick was saying, these programs are not property specific. One thing I did want to speak to is with the closing costs. It's typically, I think you had on your slide, between 2 to 5%. Do not let that number cause you to shy away from purchasing, because in the negotiating for the property, we oftentimes try to get the seller to contribute towards that amount as well.
That's a very good point. The closing costs are something that you can negotiate. I think, what was that? Yes, here you go. The closing costs are something that you can negotiate with the seller. If you have a seller that's willing to pay some of the closing costs. Sometimes you have a seller that's willing to drop the purchase price of the home. Let's say if the home's listed at $300,000 and they're willing to take $295,000, you can put $5,000 instead of taking the discount on the sales price. You could say, okay, I'll pay $300,000, but put that $5,000 toward my closing costs. And there's other places where you can put that $5,000 as well. Again, that I can talk with you on a one-to-one basis about, because I have a lot of other tricks and tips to help you save money and over the long haul. And I'm not talking like a little bit, I'm talking thousands and tens of thousands of dollars over the life of your loan. So there are a lot of ways that you can save some money. But no, thank you, Cynthia, for that. You can definitely negotiate the closing cost when you place in your offer as well to buy a home.
One thing I will say is that I, as an instructor and an educator and for Georgia and for the National Association of Realtors, and I also have a real estate school that I operate, that's my goal. And I'm sure that's Frederick's goal as well. That's why he's doing this webinar. And that is to educate the consumer so that when you complete your transaction, is a process that you understand and that you're able to know what you did, how you got there. So that is one of the missions that we're on, is to educate the consumer.
No, absolutely. And I can say that this is definitely my passion. I have not been more passionate about a position that I have held as I am about being licensed as a loan officer. It's something I take very seriously, but it's also something I truly enjoy, which is helping people to be able to make one of the biggest purchases of their lives, which is the home. So it's something I love, it's something I enjoy. And yeah, I look forward to just being able to do a lot more of it in the near future. So let's see, so that says with the average price of homes in desirable areas at an all-time high, what do you recommend buyers do to use these programs to find a good deal in an ideal area? Cynthia, you want to speak to that a little bit?
Okay, let me read this. It's with the average price of homes in a desirable area at an all-time high, what do you recommend buyers do to use these programs to find a good deal in an ideal area?
And before I put you right on the spot, I will say really quickly, one of the things that I recommend, and Cynthia can talk a little bit more to the negotiating tools that you have available to you when you're negotiating prices and everything, but buy downs are one way that you can utilize those tools, and that also plays into the negotiating as well. So your loan officer and your real estate agent should really be working hand in hand because it plays into the negotiation as well. But utilizing buy downs to buy down your interest rate can help bring down your monthly payments, thereby allowing you to be able to qualify for a home that has increased in price, because sometimes those homes, as they increase, do get out of your price range. But if you're able to utilize a buy down to buy that interest rate down, it decreases that monthly price that monthly payment that you would make, allowing you to be able to qualify for that home. And sorry, Cynthia, I cut you off. You were saying?
No, you're fine. Absolutely. How can buyers use these programs to purchase in quote ideal areas? First, know your purchase power. First, talk to a lender, know your purchase power, and make sure that the program, and understand the details that are left. I mean, the details that are available to you. And those are things that we can talk to you about as well on a one-on-one basis, because areas fluctuate in price point.
Yeah, unfortunately, prices are what they are right now, but utilizing buy downs is, I would say, probably one of the bigger tools that you have, because you can't strong arm a seller into selling if you want them to sell, if they don't want to sell at a lower price or anything like that. So definitely reach out to me, give me a call, reach out to Cynthia as well, and we can go into more detail with you about some of the other tools that are available, but buy downs would be the biggest one. So I don't see any other questions in the chat. I don't want to take up too much of your time. I want to be respectful of that. So thank you, Cynthia, for logging on. Thank you to all of you who took some of your time out of your day to bless us with your presence. And I just wish you the best. Please do reach out to me or Cynthia or both of us, and we would love to help you with your home journey. So that's all we have. Take care, be blessed, and Merry Christmas to everybody. Happy holidays.
Same here. Thank you.